It's very common and even expected that high-quality companies will trade at a premium to the market. They generally exhibit one or more factors that investors seek, such as a strong competitive advantage, faster growth, higher profitability, or better predictability. And when you find such companies, it's exciting. The vision of massive gains in a portfolio that outperforms the market over a 10, 20, 30-year period jump into your head, creating the tendency to overpay for these companies because you know that by adding these companies to your portfolio, the quality of your overall portfolio will be better. But you have to be careful not to overpay because it increases the likelihood of subpar returns even if the companies continue to do well. Investing is a game of patience and opportunity, so in this video we're going to go over 10 overvalued high-quality companies that I have my eye on. I'm waiting patiently for any one of them to drop into fairly valued or undervalued territory so I can scoop them up at prices that I'm willing to pay. And make sure you watch till the end because I'll walk you through how to buy a company that you want for the price that you want. All you have to do is be patient and you'll get paid to wait for the stock to drop to the price of your choosing. So without further ado, let's get on to the list. The least overvalued company on this list is Chipotle, ticker CMG, the Americanized Mexican fast food chain that brands itself as better for you. Although they do business in an extremely competitive industry, they've been able to drive fantastic growth and profitability. They're not at the level of McDonald's, Yum Brands, or Domino's in the industry, but they're more profitable than many well-known competitors such as Starbucks, Texas Roadhouse, and Restaurant Brands International, which owns Burger King and Popeyes. And they're growing faster than all of them, including the much smaller Texas Roadhouse. Other than their growth rate and profitability, what I really like about Chipotle is the fact that they're primarily a fully owned company, and their international footprint is practically non-existent with just 84 international stores. Both of these offer new avenues for growth and potential margin expansion over the next decade. In fact, they just started franchising in 2023, and we all know what a successful franchising business model can do. Just take a look at McDonald's and Domino's Pizza. Profitability and capital efficiency can skyrocket if done properly. Better yet, they are debt-free other than their leases, so they have ample capacity to take on debt to finance their international expansion and increase share buybacks in the future. So far, everything has been financed through cash flow, which is a great thing to see. It shows that management is focused on sustained, profitable growth rather than growth for growth's sake. But the thing that really piques my interest in Chipotle is their 40 million rewards members. The sheer size of their rewards program puts them in the same league as some of the most successful loyalty programs in the industry, such as Domino's, Starbucks, and Panera. This allows the company to use their vast customer data repository to execute targeted advertising by using AI to study customer behavior and then funneling customers to the most profitable channels as possible. I haven't even touched on their laser focus on digitization and productivity improving investments that should pay off over the years to come. But because of the sheer level of competition, I personally stay away from the restaurant industry because it's so competitive. I'd need an insane value to invest in the space, but if I were to choose one to buy at a significant discount, it would be Chipotle as my first choice, followed by McDonald's and then Texas Roadhouse. But currently, I don't find any of these companies trading at a large enough discount to warrant my attention. I value Chipotle at $44 per share based on my base case of 15% earnings per share growth and a 30 PE, my bear case of 10% EPS growth and a 25 multiple, and my bull case of 18% growth with a 40 multiple. I'm just not going to give a restaurant a base multiple of 40 times. It just ain't gonna happen. In my opinion, the 35 that I gave Chipotle is too high as is, so I think my valuation is generous. And Morningstar and CFRA agree, with Morningstar coming in at $46 per share, while CFRA puts a $39 price tag on them. Next up, we have the credit rating and data analytics duo, Moody's, ticker MCO, and S&P Global, ticker SPGI. I'm combining these so I can fit more companies into this video. These are some of the best companies you can own, but as is the point of this list, they're overvalued. The ratings businesses of these two companies are deeply entrenched toll booth style businesses that is essentially a duopoly, with each one holding about a 40% market share. Moody's was founded in 1900 and S&P 40 years earlier in 1860. And over the last 125 years, these companies have established deep relationships and acceptance from regulatory bodies and financial institutions throughout the world, to the point that they've created a de facto barrier to entry and switching costs. And some banks will not underwrite a debt offering unless it has a rating from one of these top 3 companies. Also, Morningstar estimates that bond issuers, aka companies borrowing the money, are able to reduce their interest rate by between 30 and 65 basis points by obtaining a debt rating from one of these 2 companies. All of this translates into very strong moats that lead to strong pricing power. Historical data from S&P Global shows that they've been able to raise prices by about 3 to 4% per year on average. These ratings businesses are mature, yet highly profitable segments that are growing in the high single digits and forms the foundation of these 2 companies. They both offer data and analytics services too. This segment has been the growth engine for both companies over the past 15 years. With 95% of revenues in the segment coming via a subscription plan, they're able to lock in their customers and keep them for the long haul. This segment is growing about 10% per year, with S&P growing a little faster, mainly because it's wide moat, world-renowned indices business. S&P's indices business and its relative valuation is what leads me to choose S&P Global over Moody's if I had to choose one. Both are highly profitable, both are highly dependent on financial markets. Economic downturns and uncertainty tend to hurt their businesses because companies are less likely to IPO, borrow, or enter into large contracts in such environments. Because of this, there is some minor cyclicality in their business, but over the long term, these 2 companies have as good a competitive position as can be. Cyclicality is just part of the deal, and if you're an investor that is willing to buy semiconductors, this is a cakewalk. S&P is growing faster and has slightly better revenue diversification, while Moody's is more stable, offers faster dividend growth with less debt. Of all the companies on this list, Moody's and S&P Global are in the top 3 of the companies that I'd be scooping up during a major correction or recession. I value S&P Global at $430 per share. They're currently trading at $522 for an overvaluation of 18%, while I value Moody's $325 per share. They're currently trading at $489 for an overvaluation of 34%. My base case for both of these companies is they basically replicate the growth rates that they've been able to achieve over the past 10 years, because there are 3 main factors at play here. First is the expected new issuance, which has been at historical highs over the past 5 years, which is why you see these firms' free cash flow per share growth rates up in that 40 to 50% range over the past 2 years. Second are refinancing of existing debt, which will put a pretty high floor under their cash flow growth as the mountain of debt that is outstanding in both corporate and government world gets refinanced over the next decade. And the third factor at play is the possibility of a recession or just a general decline in new debt issuance as companies choose to pay down debt balances given that interest rates are likely to stay elevated. Finding a reasonable balance between these 3 scenarios leads me to believe that it's reasonable and, dare I say, prudent to expect a bit of a reversion to the long-term mean. And in my opinion, the 12 to 18% range with a 10% floor is reasonable. I have S&P Global growing slightly faster than Moody's given their analytics and indices businesses, which have been growing faster than the ratings businesses, while Moody's generally trades at a slightly higher multiple than S&P Global does. As far as Morningstar goes, they value both of these companies at much higher than I do, with Moody's at $460 and S&P Global at $540. So according to Morningstar, these rock-solid, wide-moat companies are currently trading right around fair value, while CFRA is more in line with my valuation, just not to the same magnitude. CFRA sees Moody's as fairly valued with an intrinsic value of $428 and S&P Global quite overvalued with an intrinsic value of $357. With the exception of Moody's, we've gotten through the stocks that would need to drop a reasonable 10 to 20%, which is common in a standard bear market. These final 8 stocks would have to absolutely tank in order to get my interest, and we're going to start with Veeva Systems, ticker VEEV. Veeva is a global cloud-based software company that caters to the life sciences industry by offering customer relationship and lifecycle management tools, data analytics tools, and various medical industry-specific apps used for the clinical, regulatory, quality, and safety functions that are so vital to pharmaceutical and biotech companies. They compete directly with other more well-known CRM software providers such as Salesforce, Oracle, and IQVIA Holdings, but they differentiate their offerings by focusing only on the pharmaceutical and biotech industry, which has allowed them to secure some significant competitive advantages. They face very little competition because there aren't as many good options for pharma and biotech companies to employ a CRM tool specifically tailored to their processes and workflows. And given the highly regulated nature of their industry, they desperately need such tools because generic CRM providers such as Salesforce do not have the in-depth industry knowledge that can help unlock the true productivity uplift potential that Viva's highly tailored software can. Their first mover advantage has allowed them to build meaningful and tangible assets centered around industry-specific data collection and knowledge assets due to their 15 years of experience working with the pharma and biotech industry. And that's not it. Because of the critical nature of their offering and the fact that it's software-based, the more modules that their customers adopt and the longer they use Viva's solutions, the more and more entrenched Viva's software becomes into their customers' operations, creating massive switching costs. Viva has this segment of the market pretty much cornered at the moment, and you can see the benefits in pretty much all their metrics. Revenues, free cash flows, and earnings per share growth has been outstanding in the 20% range over the past 10 years, but this is expected to slow to the mid double digits over the next 5, which is still impressive, and the reason they trade at such lofty valuations. They also support 25% margins, which are slowly trending upwards. They have $5 billion in cash with very low debt. They're surprisingly about as volatile as the market with a 0.97 beta, and they're actually up year to date, demonstrating the resilience during all this tariff talk and the potential disruption of the AI build-out. On the negative side, like most small software companies, they have a stock-based compensation problem eating up 30% of their free cash flow, which is contributing to the dilution of their shareholders at about 1% per year, which, to be fair, isn't horrible for a small software company. It's less than Amazon. And finally, they trade at a 64 PE and a 1.5% free cash flow yield, which is very rich. But based on my assumptions, they're worth $212 per share, but are trading at $280 for a 32% overvaluation to my fair value estimate. My base case is that they grow their free cash flow per share at 13% per year over the next 5 years with a 30 multiple, which is actually quite a bit lower than their long-term average. My bear case has it dropping to 10% growth and a 25 multiple, while my bull case has it increasing to 18% growth with a 35 multiple. In contrast, Morningstar values them at $275 per share, so they think Viva is appropriately valued at the moment, while CFRA estimates that they're worth $243 per share. Fourth on the list is the cybersecurity duo CrowdStrike, ticker CRWD, and Fortinet, ticker FTNT. Cybersecurity has always been of paramount importance, but given the world's push towards digitization of pretty much everything, cybersecurity is becoming more and more important for every single company around the world, and this trend will likely continue for decades to come. This means that cybersecurity is a good place to be as an investor. The problem is that the market has anticipated this, and we find ourselves with a couple good companies, but we're going to have to pay up if we want to own them. CrowdStrike is the up-and-coming high flyer with the immense growth and profitability potential, while Fortinet is a more mature company that has already established itself as a highly profitable, highly predictable company whose growth rate is nothing to sneeze at either. CrowdStrike focuses on a more nimble, cloud-based offering with a land and expand approach focused on endpoint security, while Fortinet takes a more old-school, physical hardware approach to lock their customers in from the beginning. Fortinet offers pretty much everything CrowdStrike does. They have a much more comprehensive suite of offerings than CrowdStrike does, but CrowdStrike is strictly cloud-based. I did deep dive videos on both of these companies last year. I encourage you to watch them both to really understand the pros and cons of each company and to make the right decision based on your investing style, risk tolerance, and financial goals. Personally, I'd choose Fortinet over CrowdStrike if given the chance to buy them both at their intrinsic values because I prefer more steady, predictable, mature companies, and that's Fortinet. CrowdStrike has immense potential, but they are also a very unpredictable company with an expense problem. They've doubled their revenues over the past few years, but they've remained in a net loss position because they've been unable or unwilling to control their expenses. A lot of the increase in their expenses are due to needing to spend lavishly on research and development in order to establish and grow their footprint in the cybersecurity market, but it's also because they have completely lost control of their stock-based comp. I understand giving out stock-based compensation as a relatively newer company in order to attract top talent and hopefully take market share in this lucrative market, but they consumed 79% of their free cash flow with stock-based compensation. Come on. Even the most ardent supporter of CrowdStrike can admit that such levels of stock-based comp are completely absurd. I have CrowdStrike valued at $323 per share, which is a 31% overvaluation based on my base case that they grow free cash flow per share at a 20% rate over the next 5 years with a 50 multiple. I value Fortinet at $67, which means I estimate that they're overvalued by 34%. based on my base case that they grow free cash flow per share at 13% with a 25 multiple, but if all goes well and my bull case plays out, they could grow around 18% per year with a 30 multiple. Morningstar, on the other hand, puts CrowdStrike at $330 and Fortinet at $108, and CFRA values them at $478 and $92 respectively. Fifth on the list is the surprisingly profitable auto parts retailer AutoZone, ticker AZO. AutoZone is one of those slow and steady companies that just keep surprising investors, and with the average age of cars steadily increasing, which translates into higher repair, parts, and maintenance spending, it should keep on chugging along. I did a deep dive video on AutoZone, so if you want more details into their industry, competitive dynamics, and financials, go check it out. Revenues have been growing in the 6 to 7% range over the past 10 years, and that includes a 9% clip over the last 5. And when I think of an auto part company, I think of a lot of expensive store space and inventory, thousands and thousands of employees with the associated wage and benefit inflation, and gross margins that are by no means robust. But this company's supply chain is so efficient and their vendor relationships are so favorable that they've been able to drive consistently expanding margins over the past 20 years. They've gone from an 8 to 9% baseline net margin to the current 14% over that time frame. Said another way, they've increased their profitability by 50% over the past 20 years, which has driven their 10% increase in net income over the same period. The thing that really makes me uneasy about AutoZone is that they borrow heavily to buy back their shares. They've bought back 6 to 7% of shares outstanding on average every year over the past 10 years. There aren't many companies that buy back shares at this rate. Combine their buybacks with their increasing profitability due to efficiency gains, and you get the 17 to 18% growth in earnings per share that they've been able to achieve. This has driven one of the most steady and consistent 400% returns I've ever seen in a chart. It's almost literally a 45-degree line. And their beta is 0.44. This is almost an ideal company until you realize that all this borrowing to buy back shares has caused their equity to go negative $5 billion. So as an equity investor, I'm paying $3,664 to buy one 18 millionth stake in a company for which I get no equity should the company go bust. Sounds like a scam, does it not? Imagine if a friend came to you with a proposal to go into business together, but when you put money into the business, you would immediately lose $14 in equity for every $3,600 you invested. The only way you would make a return on your investment is for the value of the shares you hold to go up. Now, don't get me wrong, I don't expect AutoZone to go bankrupt anytime soon. Far from it. They should actually do relatively well during a recession, and they've quadrupled the value of their stock over the past 10 years. But who knows what will happen over the next 5 to 10 years. Based on my assumption, they're worth $2,795 per share, but they're trading at $3,664 for a 24% overvaluation to my fair value estimate. My base case is that they grow their earnings per share at 12.5% per year over the next 5 years with an 18 multiple. My bear case has it dropping to 8% growth and a 15 multiple, while my bull case has it increasing to 17% growth with a 22 multiple. In contrast, Morningstar values them at $2,830 per share, while CFRA estimates they're worth $2,849 per share. The sixth least overvalued company on my watch list is Netflix, ticker NFLX. We're all aware of the quality of Netflix. It's one of my favorites, but it's also expensive, trading at a 53 PE and a 1.5% free cash flow yield. I did a deep dive last year on Netflix, which you can check out on my channel if you want my detailed thoughts, so I'm not going to rehash all the details other than to say that even though Netflix is considered a tech company, they bring very strong resilience during a recession. At only $8 for their standard plan and $25 for their premium plan, almost nobody is going to cut that even when money is tight because it's not a lot of money. It's not like the legacy TV companies like Spectrum and Time Warner where you have to pay $100 plus per month. This really ups the quality and predictability of this company, which is one of the reasons, in addition to its growth and profitability, that causes it to trade at such a lofty valuation. This is not to say that their stock price won't tank during a recession or a tech bust like we saw in the early 2000s. It absolutely will. I'm talking about the underlying business fundamentals, and because of this, I don't think it will take as much as names like the Mag 7 and other pure tech plays. As far as valuation goes, I estimate they're worth $842 per share, while they're trading at $1,140 for a 26% overvaluation to my intrinsic value. My base case is that they'll grow earnings 18% with a 30 multiple. My bear case is 15% growth with a 25 multiple, and my bull case is 22% growth with a 35 multiple. On the other hand, Morningstar values them at $720 per share, while CFRA is much more optimistic at $1,050 per share. So according to CFRA, Netflix is right around fair value at this moment. Next up, we have my Disneyland, Costco, ticker COST. Costco is an incredible company. Even though it's a mature, slow growth company, it just keeps chugging along, producing stellar returns year after year. And better yet, it sells necessities. So it's a great defensive stock. Actually, I think it's the best defensive stock in the world. The problem is, I'm sure you know what it's going to be, their valuation. A 59 PE for a company that generates a 3% profit margin and free cash flow margin. They don't buy back shares, and you expect me to pay 59 times earnings? No thanks, I'll pass. I did a deep dive on Costco last year, so feel free to go check it out if you're interested in Costco and want all the details. But I value them at $592 a share, which means they're trading at a massive 42% premium to my intrinsic value. This is one stock that I'd be willing to pay more than what I think they're worth. There aren't many of them, but Costco is one. I think I'd go up to maybe around $700 if I got the opportunity. I'd love to own this stock, but it looks like I'm going to have to wait a long time for my opportunity. Morningstar places a 610 fair value on them, and CFRA says they're worth $735. Eighth on this list is Fair Isaac Corporation, ticker FICO, the data analytics company most well known for their credit scores business. This is a great business with a business model similar to Moody's and S&P Global that we just talked about. Just like the credit rating agencies have entrenched themselves in the corporate debt market, FICO has entrenched itself in the consumer debt market. There is almost no company that will lend to a consumer without pulling your FICO score. This has produced surprisingly low revenue growth of 8% over the past 10 years, although this has accelerated to the 12 to 13% range over the past 2 years. Whether they keep that higher rate of growth up will remain to be seen, but the market sure seems to believe they will. This has led to 50% returns on capital and 30% free cash flow margins, which is literally world class. All of this has led to their huge outperformance of the market, going up 3x over the past 5 years and 18x over the past 10. Their run has been incredible, which is the reason I want nothing to do with this stock at these prices. This is one of my candidates for the biggest crashes when we do get a major multi-year bear market, probably during the next recession. It's just gone too far, too quickly, even if it continues to grow like it has and maintains its profitability. Unlike Costco, I'm very confident that I will have the opportunity to buy FICO near or even lower than my intrinsic value over the next 10 years. I value them at $1,007, a 41% discount to the $1,694 that they're currently trading at, and my assumptions are quite generous. My base case is that they grow free cash flow per share 15% with a 30 multiple. My bear case is 12% growth and a 25 multiple, while my bull case is 18% with a 35 multiple. Morningstar has them at $1,600, while CFRA values them at $1,741. Ninth on the list is the industrial supply company Fastenal, ticker FAST. When you think of an industrial supply company, you think of an old school, outdated business like a railroad or something. That's certainly what jumped into my mind when they came up on one of my screens several years ago. And although there is some semblance of that with this company, they are a well-oiled machine that has fine-tuned their supply chain, giving them a cost advantage versus their competitors. And their install base of on-site vending machines and inventory management services creates switching costs, thereby making it very expensive to move to a competitor. Their wide moat is apparent in their 30 to 35% returns on capital and constantly increasing net margins. You don't see this level of returns on capital in some software companies, let alone an old-fashioned industrial supply company. All of this translates into a company that is able to keep its debt in check, increase its free cash flow by 10% per year, and grow their dividend by 12% per year. They sell their products worldwide and therefore are fairly impacted by all the tariffs. But the odd thing is that they only dropped around 10% in early April, but quickly bounced back and even surpassed their previous 2025 highs in a single week. That's the way it goes with this company. I'd love to increase my stake in this company, but it's almost always trading at a high valuation, and you don't get many chances to buy the stock on a significant dip or at reasonable valuations. It's kind of like the Costco of industrials. Given their slower growth and my unwillingness to give them a multiple around where they always trade, I value them at only $18 per share, which means that I estimate they're 58% overvalued. My base case is 10% free cash flow growth with a 26 multiple, while my bear case is 8% growth and a 20 multiple, and my bull case is 12% growth and a 30 multiple. Morningstar values them at $30, and so does CFRA. And finally, we have Palantir, ticker PLTR, the most overvalued stock of the 50 that I track and possibly in the market at the moment. Trading at a 261 forward PE and almost 100 times sales. No matter how you cut it, they're severely overvalued even after factoring in this year's 42% expected growth rate. Palantir's software platforms provide the infrastructure required to integrate data from pretty much any source, regardless of their incompatibility, and deploy them for analysis, modeling, and insight generation using AI and machine learning. And their platforms are highly adaptable and customizable. That's what makes Palantir so intriguing. Each platform comes with user-facing applications designed for a vast array of industry-specific uses, and it can be deployed in almost any environment. This leads to the belief that Palantir's total addressable market is in the $1 to $1.5 trillion range, according to Morningstar. Combine that with their expected 42% growth rate and the fact that they've already established consistent profitability and positive cash flow, and it's no wonder this is the next overvalued high flyer that everyone is talking about. But that's not it. They benefit from significant switching costs. Palantir's value proposition is that not only do they organize and display the data, but they also create prioritized, ranked data that can quickly be understood and interacted with, driving real-world efficiency gains. And given the power of their offerings, their software is usually deployed in mission-critical segments or processes within a company. So once a customer adopts Palantir's solutions and realizes the associated efficiency gains, there's literally a monetary cost associated with switching to another provider, not to mention the inconvenience and potential operational disruptions that could result. So where does all this leave us in terms of an investment into this company? Sinking a large amount of capital with a buy and hold approach after their huge run-up this year is risky and, from my perspective, not advisable. Now, you actually have several options, but I'm focusing on the two that are most simple and limit your risk. First, you could buy a call option, which allows you to purchase 100 shares of the company at an agreed upon price by an agreed upon date, while significantly reducing the amount of capital you have to invest to have that option. I'm not going to go into detail about call options in this video, but if you don't know how they work and you'd like to learn, leave a comment and I'll make a video in the near future. The second option here with Palantir is to sell put options. This is the strategy that will allow you to name your price and you'll get paid to wait for the price of Palantir to drop. How will you get paid to wait, you ask? Well, you sell an option, not buy, but sell. You collect a premium for selling that contract. So we are going to receive the premium upfront in exchange for giving someone else the option to sell us their Palantir shares at an agreed upon price by an agreed upon date. Let's take a look at Palantir's put option chains and go over an example. Let's say that you wouldn't mind owning Palantir at $85 per share. Keep in mind that options deal in 100 share quantities, so you would be risking $8,500 at an $85 strike price. And you would have to have $8,500 in cash in your account at the time that you initiate the contract. This is known as a cash secured put. You could use margin and would only have to put up a fraction of that, but I don't do margin. I suggest that you don't either. So let's say you had $8,500 in cash, and if you had the chance to invest the $8,500 in Palantir at $85 a share, you would take that opportunity. For that, you would receive a premium of $680 right when the contract is initiated. So you're receiving $680 in income and risking $8,500. This is an 8% return right off the bat. This is almost twice the return of a treasury. And because the contract expiration is 243 days away, if we convert that into an annualized return, it's about a 12% annualized return. Just for taking the risk that you would have to invest $8,500 in Palantir at $85 per share, something that you wouldn't mind doing anyway. In this case, the ideal outcome is that Palantir remains above $78.20, which is your $85 strike price, less the $6.80 premium that the other party had to pay. If that happens, you keep your $8,500 and the $680 premium, and nothing else happens. You don't get to buy the Palantir shares. But in the case that the price of Palantir drops to $78.20 and you're forced to buy the shares at $85 per share, well, you still keep the $680 premium, and you get 100 shares of Palantir that you wanted to own anyway at a price of your choosing. In other words, you got paid $680 to buy Palantir at $85 per share. The good news is that you could do this with any stock on this list. The amount you'll get paid and the strike prices will be different, but the general strategy of selling a long-term put option, collecting the premium, and waiting for the price to drop to whatever price you choose can be exercised on any stock. I know this was a lot to take in if you're not familiar with how options work. Feel free to leave your questions in the comment section and I'll do my best to clarify anything that we discussed in this video. Well, that'll do it. I'd love to hear your thoughts in the comments. Do you hold any of the stocks that I mentioned? Do you disagree with any of my valuations? If so, please leave it in the comments. Also, please make sure you like this video and subscribe to my channel so you don't miss any videos when I release them. It's a quick and free way you can help me grow this channel if you find this content valuable. Lastly, if you're interested in other high quality companies that could be good buys right now, click on one of the thumbnails you see on your screen. Until next time, you all take care. I'll see you in the next one.